When you're making hundreds of millions of dollars, you're not interested in these super huge pumps on the market. The huge pumps are for the brokies. Why? Because they have to gamble the most. Because they enter into the market with $1,000, with $2,000. Some people go with five, with $10,000. And the road from 1,000 to a million, from 10,000 to a million, it's a long road. They're the ones that should hold the longest. They're the ones that should gamble the most. Rich people are not the biggest gamblers. Why? Because they're entered into an investment with 1%, 3%, 5% potential upside. They're gonna put 5 million, 1 million, $10 million. The market will pump a little. They're gonna make 1 million, they're gonna make 2 million, they're gonna make 3 million. It's okay. They're not here for the biggest gamble. The broke boys are the ones who enter with the smallest amount, taking the largest possible gamble, and they have to wait the longest because they don't have no money. This is why the super huge pumps, when you see some new hype coin, new hype stock, new hype project, palladium, some of the precious metals that you probably never heard of, and any stocks or derivatives related to this new hype, you should stay away from it if you're a broke boy, because you are the target. You are the exit liquidity for all these people. I want you to remember this. The biggest hype cycle, the biggest gambles, the biggest promotions from the brokies on the social media are only for the people who do not have money. No one with the position and with the money, with hundreds of millions of dollars net worth, will be waiting and will be gambling and will be going after some of these crazy nonsense situations. Have you ever heard some of these multimillionaires or billionaires lost money on Luna? No. Have you heard some of these very, very wealthy, successful investors lost money being rug pulled on any of these projects? No. Why is that? Simple equation matters. They're the one picking positions or investing opportunities with this could pump 1%, 2%, 3%, but I'm okay. It's predictable, it's the lowest risk possible, so I can enter with the highest amount possible. So I can enter with $10 million position, it will pump 1%, and I will be good with it. I will make 100K. If it pump 10%, I can make more money, right? But that's not the main equation. The main equation is to find an investing opportunity where you have the smallest gamble, the smallest risk possible. So then you can enter with the high amount, which the brokies are doing the complete opposite reversion, where they're looking for the biggest gamble possible, where the odds of success, the divergence between the possible positive versus negative outcome is outstanding. It's outrageous. Okay, you have situations where the delta indicates that you have negative percent chance of succeeding. Okay, this is how ridiculous entering in this position is. But these people are entering into the highest gamble, lowest probability, with also they're entering with the lowest amount possible because they're broke, right? They don't have money. So they enter with $1,000 to a 0.00012 probability of success, and they have to wait the longest time period possible, because for them their $1,000 investment to compound to $1 million, you can do the math and you can understand how long it will take, because there is a lot of money to go in on the buy side to push the particular coin or stock to go that high. They have to hope everyone else that invests to not be as broke as them, because they're going to pull money off the table. They're going to take profits. So which will create a chain reaction, which will create a liquidation, sell-offs, taking profits. And halfway through, they might actually go back from being profitable to being unprofitable, losing money below cost basis whatsoever. Then they have to hope that, the project is legit, the project is not a scam, because you might see crazy pump and then everything could go to zero because someone identified that it's a scam. Then they have to hope that there won't be any particular big institutional holder who owns majority of the stocks or the crypto, which will dump at the very moment. You see how hard it is to actually make a lot of money with gambling on crypto or stock market if you are broke. If you have a substantial capital, it's very easy. Why it's easy? Because you're taking the smallest risk possible, you enter with large amount, and 1% pump you're good to go. 3% pump, 2% pump, which is pretty common, especially in the crypto market. If you're in the right projects, 1 to 3% on a daily basis is pretty normal, pretty average, not substantial, not extraordinary. So it's kind of predictable, right? So this is why you need to understand that these people are not gambling. Rich people are not getting richer by gambling like crazy. They don't throw darts at the board, right? Everything is predicted. They're not looking for what is the next hype on Reddit today. They don't use the services that actually track individual investors hyping projects, coins, hashtags on particular new projects and coins and these blockchains and whatsoever. Why? Because there is unlimited potential downside for these projects, especially after they launch, right? A lot of the crypto projects in the beginning that were offering a yield farming, you buy the coins, you deposit the coins, and you collect yield. They were paying crazy yields, right? 1 million%, 300,000%. And a lot of these coins launch at $1, $3, they reach prices of 8,000, 9,000, and they collapse to like 10 cents, 8 cents. You understand what kind of losses we're talking about? These people lost their shirts. And like I said, imagine if you enter into $8,000 per coin position, hoping that you're going to be collecting $1 million APY, right, per year, and your percent yield, and then essentially 6 months later, somebody make a blog post that the whole project, the whole founders are scammers, everything goes to zero. You lost tons of money. Why would you gamble so much when you could, choose something that's less volatile, something that is predictable, something that effectively has a daily percentage volatility between, 1.3, 1.5, 1.8% on a daily basis, average percentage volatility for the last 30 days. And you can, effectively put as much money you're comfortable with, and you can pull it in, pull it out. It's very easy, right? There is enough liquidity, there is enough volume on a daily basis. So everything goes smooth. You don't have to be cautious and crazy, observant around the situation and investors, and you have to look at the books, who is buying, who is selling, are there bot tradings, do you have snipers involved? You don't have to, on the stock market level too, are the institutional investors, dark pools trading, where is the whole trading happening? When you get into some of these crazy gambling situations, you're putting yourself into a vast amount of stress, because then you kind of have to become like a parent of your investment. You have to follow everything that happens with your investment every single day, every single time. The volume, the trading, the cap, the liquidity, all these things that if you just pick something that is good, less volatile, something that is valuable, something that possesses intrinsic value. Now, when the hype cycle comes to an end on the A bubble, I want you to see how many companies will essentially deflate, not only value-wise, but revenue-wise. This will show you the intrinsic value and why the intrinsic value is the true measure that you want to follow. Because even during the crazy AI bubble burst, during the dot-com bubble burst, there were still companies that survived. PayPal survived during the dot-com bubble because they have intrinsic value that couldn't be detached during the crazy market downturns. Okay, some real estate properties didn't lose value during the real estate crash, 08-09 financial crisis. Why? Because they have intrinsic value, because they were purchased at the right prices, at the right location, and also they were renegotiated on a very specific terms, especially purchased with a mortgage program at mortgages very, very low. This is why you need to understand, rich people do not gamble. Forget about what you watch on Vegas. People go and play 100K a hand or whatsoever. This is not what we're talking about. Rich people are looking to put as much money as possible at the lowest risk possible, and they're looking for almost barely any move, 1 to 2 to 3%, and they cash out. 1 to 3% cash out. They don't wait for 150,000% return. Pay very close attention.